Welcome back. My name is Joshua Bellinger of CounterVest. I have a hot crypto play that looks to go to the moon, and it's one that I just came across today. And the reason why is because they had a 600% increase in calls, and they were buying calls late in the afternoon here. Now, I'm going to walk through a few interesting ways to play this, but this is a none to borrow stock, meaning that there is nothing to borrow. So any kind of squeeze is going to send it higher. So let's take a look at what I'm talking about here. Hut 8 Mining Corporation. This was traded on Toronto Exchange. It just started trading on the NASDAQ, as you can see, just about 2 weeks ago. Now, we are pushing above these levels here. On this one at 450, there's not much price discovery here. But right now, there is a hard to borrow, which means there's none to borrow. All right, it's none to borrow or hard to borrow? Let's take a look. Yeah, none to borrow. So there's none to borrow. Now, I'm not quite sure exactly on the ARB on here, meaning if buying on you can ARB it on Toronto and ARB it on Toronto with the U.S. exchange. I'm not quite sure about that. But what I'm looking at here is that I think this can outperform crypto or outperform Bitcoin and Ethereum in the next 16 days. I'm going to walk through two examples. So let's take a look here at the activity here. Activity on the July. This is where I saw the activity here on the July 5th strike here, 11,000 contracts. The biggest trade on this one was 4,713 contracts bought at 50 cents. That's when the market was 35 by 40. What that indicates is that someone put in an order that this is what's known as it's an order that it's a specific type of order that an institution will use to get filled on an order. What happens is that the institution says, I want this many contracts. And what the system will do is that it will actually look at all the exchanges available to figure out if it can get that price. Because once you start sending orders in, you start to push price. So what it does is it tries to get all of it before it enters the marketplace to try to capture that price. So they came in at 50 cents. They overpaid. That would show and indicate an aggressive buyer, which a lot of these other unusual option activity or sweeps and all these other people who are new to following this type of order flow would say, oh my God, let's follow it. But let's not just follow it. They overpaid on this one. It doesn't mean it necessarily is the best. It could be sometimes where we see this is that they try to pump it and then dump it. So right here, we'll see what sticks on the marketplace here. But you can see that there was some January interest as well. It's going to be a good name to keep an eye out for it. When you talk about a $4 stock, $4 is $4. I mean, this is essentially a penny stock as is. Or I mean, it's a penny stock, but also an option at the same time. So a lot of people try to over leverage and try to play these options here. But again, what we've talked about in many videos, go back to the playlist, we talk about this often, volatility, implied volatility. So it's already pricing in a $1.12 move higher or lower. And that's pretty significant. That's for 16 days, and we start to go out $3.40 in the next 107 days. So, I mean, nearly it goes bankrupt or it pops higher. So this is all priced into the option market. You have to be understanding and be careful of it. But one of the things I wanted to keep an eye or to indicate to you is what I would be looking for on this one is owning the stock is a much cleaner trade for it to pop higher. That's the easiest. Now, if you want to get to options, options are going to be very messy at times. But yes, you could see, it's a none to borrow. It could spike higher where this $5 stock or this $5 option gets squeezed and it goes to $5. Could happen. Another different way, and this is the best thing about it. We always start, there's three things we've talked about with trade, with what makes a good trade. It's always the thesis, trade structure, risk management. So we already have a thesis here. Something's going on here. We have an interesting, crypto's hot, could see this one pop higher. Okay, our bias is higher. Now, what's our trade structure? Trade structure is going to be based off of what we think is going to fit our risk profile. If you want to shoot to the moon, hey, that's all you. You do you. You do you, boo. But some people don't want to shoot for the moon. Some other individuals want to play it a little bit more safer or what fits their risk appetite. So one of the other ways as well is that yes, you can own shares, but maybe you think, hey, I like this company. Josh, I never heard about it. I've just looked into it a little bit more. $4, that sounds interesting. I mean, this could outperform Bitcoin over the next let's go into January, next 205 days. You get a $4 stock and it goes up to $20. I mean, that's a pretty good catch on that one. But one of the other things I want to show you as well is doing a covered call. I know it's not the sexiest thing, but one of the interesting things I came across here is creating a 50% return on a covered call if it gets $5 in the next 16 days. So let's take a look at this. I'm just using the OIC calculator here. I already filled it in, $4.40. That $5 strike was trading about 35 cents per contract. So this is what I have here. And this is a very simple calculator, but it's easier to walk through it and explain everything to you. So if you're using margin versus cash. Now, if you're using cash, it's a 23% return if the stock is called away at expiration. Called away means that prices were above $5. So you collect that 35 cents plus you get executed at $5 strike. So $5.35 is your most profit. Now, if you use margin, you can create a 51% gain. And if the stock goes unchanged in the next 16 days on a cash account, you make 8.6% return. Not bad. I mean, if you put up where are you going to make, here's the thing, where are you going to make 8% in the next 16 days on your money? Nowhere. I mean, that's where the financial markets, or the Fed has driven people into, of trying to take this risk, and sometimes unnecessary risk, to create returns. For the next 16 days, an 8.6% return if prices just stay at $4.40, not bad. And it reduces your cost, meaning that when August opens up, you can sell August. Do the same thing before it shoots to the moon. If it shoots to the moon, though, you're not going to get moon prices. You're only going to get above average return on this one here. But you get 19% on margin if you use margin on that. And then break even, again, what's our downside? Break even on this is $4.05, which is about an 8% difference here. So $4.05, you collect it. If it goes down lower, fine. If you want to own it and own it over time because you think this is going to go higher, then you start to chip away at that, reduce your cost for it then eventually to go to the moon. What you want to do is chip away at it as much as possibly can, and then when it goes to the moon, you make more money. So those are the options on here. This is actually pretty interesting. It's a cheap stock. You can do it in any account. You can start to learn covered calls, and you can make a decent return in the next 16 days just following this. I don't know why they bought these calls. You know, if you want to go back to what they're looking for on this none to borrow, I mean, they're looking to squeeze it. That's what they're looking to do. But it doesn't necessarily mean it will get squeezed. There's a lot of times we've seen over the last several months that they've tried to squeeze stocks, and it doesn't happen. Now, every squeeze is different, and there's only certain ones that squeeze more than the others, and that's because on who's on the other side of the trade, how much float is available, and whatnot. So this is an interesting play, one to keep an eye out for, but that's exactly walking through how to do something from coming to a thesis to then creating trade structure and then risk management at the end of it. So those are always the three things that lead down to a successful trade, win or loss. It's exactly what we need to walk through on any investment, always knowing that. So that's what I have for you in this video. Let me know what you think. You like it? Don't like it? Thumbs down, thumbs up, let me know. See you in the next video.